For most of us, hearing the phrase living on loans sounds, well, it sounds pretty terrifying, right? You think of credit cards, car payments, student debt. It feels like this trap that's designed to keep you stressed out and just running in place. But what if I told you that for the wealthiest people, living on loans is actually one of the smartest financial moves they can possibly make?
All right, let's get into it. In this explainer, we're going to break down exactly how this whole strategy works. First, we'll look at two fundamentally different kinds of debt. Then, we'll walk you through the five-step loop that the wealthy use. After that, we'll dive into the tax rules that make it all possible. And finally, we'll get real about the risks involved because they definitely get overlooked.
So let's kick things off with the most important idea of all. You see, the word loan can mean two completely different things. It really all just comes down to what you have to back it up.
On one side, you've got consumer debt. This is the stuff most of us are familiar with. You're borrowing against your future labor, your paycheck. You're doing it because you need cash that you don't have right now. But on the other side, you have asset-backed debt. This is borrowing against a portfolio of valuable things you already own. You're not borrowing because you're broke. You're borrowing to get cash without having to sell your assets. It's a totally different ballgame.
And this is exactly why consumer debt feels so painful. The interest rates are high because, let's be honest, a job is a pretty fragile thing to lend against. The payments, they're mandatory every single month, no excuses. And you're usually using that money to buy things like a car that start losing value the second you get them. And maybe worst of all, you have to pay it all back with money you've already paid income tax on. It's just a constant uphill battle. You know, the difference here totally changes your relationship with the bank. Here's a way to think about it. Consumer debt is kind of like a high-interest payday loan. It's expensive, it's rigid, and it's designed for someone who's in a really tight spot. Asset-backed debt, though, that's more like a flexible line of credit from a hardware store. They give it to you because they can see you own a valuable house that you're improving. The loan is just a tool for a bigger project, not some kind of last resort.
So how does this all build into a repeatable strategy? I mean, this isn't some one-time trick. It's a financial loop that people can run for decades, literally their entire lives.
It often goes by the kind of dramatic name, buy, borrow, die. Here's how it works. Step 1. You acquire assets that you expect to grow in value over time. Stocks, real estate, you name it. Step 2, and this is so important, you borrow a small, conservative amount against them. Step 3, the loans are structured to be super flexible, often interest only. Step 4, you never sell, which means you avoid triggering capital gains taxes. And finally, you just keep refinancing those loans as your assets grow, repeating the cycle over and over. Now, to really understand why this works, you have to get one concept down: loan-to-value, or LTV. It's super simple, really. It's just the size of your loan compared to the value of the thing you're borrowing against. And that number is everything, because it tells the bank exactly how much risk they're taking on. So here's the crucial point. A low LTV creates this massive safety cushion for the lender. It's kind of like taking your $1,000 watch to a pawn shop and only asking for $200. The pawn shop owner isn't worried at all because they have this huge buffer. It's the same idea here. If you've got a $50 million portfolio and you only want to borrow $5 million, the bank sees almost zero risk. And this right here, this is why they get such great deals. That huge safety buffer, that really low LTV, is what gets them lower interest rates and incredibly flexible terms. The loan isn't safe because of who's borrowing the money. It's safe because of the mountain of collateral that's sitting right behind it.
Okay, so this is usually when people ask, wait a minute, so did I ever actually pay the loan back? That's the million-dollar question, isn't it? And the answer is a little more complicated than just yes or no. It's not really about never repaying the loan, it's more about continuously refinancing it. As the assets grow in value, the old loan just gets replaced with a new one, often for a larger amount, all while keeping that loan-to-value ratio safely in the green. The debt just keeps rolling forward. Okay, so now let's talk about the fuel that makes this whole engine run so powerfully. And that is, of course, the tax code.
Here it is, the absolute game changer. When you borrow money, it is not considered income, so you don't pay tax on it. This lets you get millions of dollars in cash to spend without selling a single stock and without triggering a giant capital gains tax bill. You get the cash you need, all while your assets just keep on growing. And in the US, there's one last really powerful piece to this puzzle. It's called the step-up in basis. So when the owner of the assets passes away, the tax basis for those assets resets to whatever the current market value is for their heirs. So let's say a stock portfolio was bought for $1 million, but it's now worth $10 million. The heirs inherit it as if they bought it for $10 million. This means they can sell off a piece of it to pay back the loans without facing a huge tax bill on that $9 million in growth. And just like that, the cycle is complete.
So this brings us to our first knowledge gap. And it's a big one. It's a huge policy debate, actually. If a loan can give you the same spending power as income, but without any of the tax, should the rules be changed? It's something to think about.
But hold on. Before you start thinking this is some kind of magic money button, we have to talk about reality. This strategy is far from risk-free, even for the very wealthy.
Yeah, there are some really serious dangers here. First, there's market risk. If the value of your collateral suddenly plummets, it can trigger what's called a margin call, which forces you to sell assets at the absolute worst possible time. Then you've got interest rate risk. I mean, what if rates shoot up and your cheap loan suddenly becomes a really expensive burden? And finally, there's just plain old human risk. Easy access to cash can lead to some really reckless overspending. You have to have discipline and a serious buffer for when things go wrong.
And this is where the rubber really meets the road. Let's look at what it actually takes. To safely spend, let's say, $100,000 a year from loans, you'd need somewhere between $2 and $3.3 million in assets. This is not a strategy for someone with a few $1,000 in a retirement account. It is fundamentally a millionaire's game.
So why can't the average person do this? Well, it's because they're missing the three key ingredients that create the safety net. You need a big enough pool of assets to borrow against, enough diversification so that one bad stock doesn't sink your whole ship, and a big enough cash buffer to survive the bad years without being forced to sell. Which leads right into our second knowledge gap. You have to wonder, when a lot of very wealthy people are using this kind of leverage, how do regulators make sure it doesn't create a domino effect during a major financial crisis? What's stopping a chain reaction? And our final question really gets to the heart of the whole matter. When you step back and look at this entire system, what do you see? Is it a brilliant financial tool for managing assets efficiently, or is it a systemic loophole that just allows wealth to concentrate and grow, widening the gap between the rich and everyone else?
So let's bring this all home. At the end of the day, the biggest takeaway is that we are talking about two completely different worlds that just happen to use the same word, debt. For most people, without assets, debt is a trap. It's a way to pull tomorrow's taxed income into today. But for the wealthy, with a huge asset base and a low LTV, debt becomes this incredibly powerful tool. It provides cash for today while allowing the assets that generate real wealth to keep on growing for tomorrow. In the end, debt isn't good or bad. It's a tool, and its power, whether for good or for bad, depends entirely on what you have to back it up.